Is a 15-year mortgage a better investment? So I wanted to see what this community thinks. My daughter and her husband are taking out a $300K loan and want to do a 15-year mortgage instead of 30-year. They'll be paying over $4K a month. They say the interest rate will be lower and they can pay it off faster, even though they plan on being there less than 5 years. I think they'd be better off with a 30-year and investing the difference. Would love to see what all the smart investors in this site think. Tia: I think the better question is if they should be buying a house at all if they plan on staying there less than 5 years. A 30-year fixed $300,000 mortgage at 8 can be paid off in 15 years by paying $2,871.29 per month. A 15-year fixed $300,000 mortgage at 7.15 can be paid off in 15 years by paying $2,721.71 per month. The after-tax effect depends on their marginal tax rate and state taxes, but a crude estimate is that the difference is about $100 a month after taxes. They're saving about $100 a month by going the 15-year route, but losing the flexibility to pay less in case finances get tight. Currently a 30-year fixed-rate mortgage is 8. It is not that easy to invest the difference at returns that are higher than 8. Plus the tax difference between mortgage payments versus investment gains. Hands down the 15-year is better if they can afford it, or they don't buy to begin with if they plan to move, even though they plan on being there less than 5 years. X200B. This is a very suspect thing to do at current rates. You accumulate almost no equity in the initial years of owning unless the house appreciates significantly. With such a short buy time, it would have to go up quite a lot just to break even on various unrecoverable costs related to buying and selling. And OFC. In most of the US, renting is a good deal relative to buying right now. A 15-year is better on paper but comes with risk. What if they lose an income stream? Will they still make mortgage? If they are there 4 years, a 15-year mortgage saves them $40,000 in interest. Do you really think they could beat that in the market? A mortgage is forced savings. Your average idiot isn't going to save the difference that you're imagining. That's like saying people who rent will save the difference from owning. They won't. They'll find excuses to spend that cash. They'll have lifestyle creep. A mortgage prevents that. It depends on the difference in the rates between the 15Y and the 30Y. If they were the same, the best plan is to go with the 30Y and pay it as if it was a 15Y. Same payoff period but added flexibility should money get tighter for a bit. Why not take 30-year loan and pay it like 15 years? Buying a house right now and to live in for less than 5 years? They will probably be upside down AF when they go to sell. Why don't they just do a 30-year and make 15-year payments? One option is to take a 30 but pay it as if it is a 15. That way they have the flexibility of a smaller payment should they need it in the future. Yes, just ask them to rent. Do the 30 years and make 15 years payments. Pay it off sooner and have the flexibility of a 30 years payment if money gets tight at some point. Get the 30 years. Make aggressive payments, but don't hand tie yourself. Depends on how much lower the interest rate and how much $4,000 is of their take-home pay. If it's more than 50, they may be better off with the 30-year. At current interest rates, it's a toss-up at this point. However, if they take home $20,000 a month, then it really doesn't matter as they will be able to save plenty. If they plan on being there for only 5 years, why buy? Only reason to buy a home is if you plan on staying in it for 15 years, in my opinion. What is their rate for 30 years vs 15 years? Take that information and run a calculation with extra payments on the difference for the 30 years. You may find they pay less and will have an overall lower mortgage if anything bad were to happen. What's the rate difference? I've never been a fan of 15-year mortgages simply because you can always pay more, but you can rarely pay less. I'd argue that it would be better to get a 30-year and pay the same amount they would have paid for the 15-year. Pay the 30-year mortgage amount, and then as a separate payment towards principal, adding the leftover that was part of the 15-year total. This allows them to pay more directly towards the principal and gives them the flexibility to pay less in a month should something go financially south. Also, they need to consider if the market is going to sustain home prices in their area for the next few years. Owning a home can be expensive, and selling one eats a lot of equity when paying realtor fees and taxes. Conversely, if the interest difference isn't huge, take the 30-year with lower obligated payment and pay on it like it's a 15-year. If SHTF, your obligated payment is lower. Why would anyone take the 30 and pay it off if you can in 15? If shit happens, you have a cushion. This the best time to rent and keep it moving. If they must buy, just get a smaller house and upgrade later. I would go with 15-year if they can afford it. Not many people could do that. I'd take the 30-year, and if they have the ability, make payments that they would for a 15-year. Keeps the flexibility to drop the payment back to the 30-year rather than locking into the 15-year payments. Mortgages are not investments. Also, why even own a house for less than 5 years? The commissions will eat you alive coming and going. And if the price falls, they could easily lose the down payment. For someone who is planning for staying for 5 years, at current rates, a 30-year makes more sense. The spread on a 30 to 15 is only about 50 bits per second. If the spread was wider, it may make more sense to take the 15, save the additional monthly payment on the side, and wait to see if rates are coming down. Wait the 5 years, and see where they are. Then either hopefully sell or refinance. And if neither of those options are attractive, you could always start paying on a 15-year schedule. To put things in perspective, on a $300,000 loan on a 30-year amortization, the difference between 8 and 7.5 is $103 per month. If they intend to pay it off in 5 years, they should look at ARMS to see if there is savings. 151 ARM. Amortized over 30 years, but they could make the payment as if it's a 15-year mortgage, so it's on track to be paid off by then. Also gives the flexibility of making the lower 30 years payment if cash flow is an issue at some point. You can get a 30 years mortgage and pay it off in 15 years. That's probably best since none of knows the future. Best to you. Get the 30-year mortgage and make one extra payment to be paid off in 17 years or so. That way if you run into troubles, your monthly payment hopefully won't be too high for you. Take 30 years. If you have extra PYA mortgage like a 15-year, your primary residence is a shitty investment. If they can afford it, the answer is yes. Buy the real estate. They also need to invest as well. If they can't buy the house and also invest, they need to back it down to a 30 and still invest, but put everything they can on the principal. When the opportunity happens to buy real estate, you always buy. They're setting themselves up amazing for the future to scale or have very little mortgage later in life. Good for them. If they are staying less than 5 years, they should rent. But things change. When I bought mine, I expected to stay about 3 years. 20 years later, I'm still here. No.